Welcome back to Boring Currency, where we track physical metals, paper market stress, and the forces reshaping the global financial system. Picture this moment at 10 wide a.m. While most small investors were asleep or frozen in front of their monitors watching their wealth disappear, a silent purge was triggered inside the Chicago Mercantile Exchange. This was not a routine correction. This was a forced confiscation of leveraged positions. Focus carefully on this number. The margin requirement to hold one silver futures contract is no longer $12,000. That figure has been violently increased to $76,000 per contract. A leverage structure of 378 to 1 shattered instantly. What you are witnessing on the ticker is not ordinary selling. It is the sound of thousands of margin calls detonating simultaneously. Welcome, silent observers, those who trust physical weight rather than paper promises. Right now, I have a simple request. If you are sitting there devastated, watching distraction videos to numb the pain of a 50% loss, turn them off. Do not allow emotion to sabotage your clarity. Repairs, both financial and psychological, are expensive. Focus on what matters. The numbers you are about to hear are not lottery results. They are the official death notice for over-leveraged speculation. What unfolded last night was a forced fold. There were no negotiations. Before we proceed deeper, report your location. Are you in New York watching the collapse unfold, in London feeling the cold uncertainty, or somewhere across Asia waiting for relief? Leave your coordinates below. Do not let the red candles deceive you. This crash was engineered, not accidental. To understand why your account vanished so quickly, we must examine the number $76,000. Let me explain this number in the simplest possible way. Even if you never participated in the futures arena before yesterday, imagine the silver market as a poker table. Previously, the entry deposit was manageable. But last night, the exchange abruptly changed the rules mid-game. They saw silver accelerating toward $120. They saw retail traders becoming euphoric, and then they intervened. They raised the maintenance margin for a single silver contract to an unthinkable level, $76,000. Visualize this scenario clearly. You were renting a luxury apartment. Last month, rent was $1,000. You were comfortable, living peacefully. Suddenly, at 3 a.m., the landlord bursts in and demands $7,600 immediately, or you are evicted. You cannot create money instantly. You cannot obtain financing at that hour. You have only one option. Leave. That means selling your position immediately. That is exactly what happened to thousands of investors. They were expelled from their silver positions because they could not meet the new collateral requirement. Selling triggered more selling. Prices collapsed, not because silver lost value, but because holders ran out of liquidity. Yet the story becomes even darker. Gold margins also increased, but only to $46,000. Do you see the imbalance? To participate in silver, you now need nearly double the capital required for gold, despite gold's much larger market size. Why target silver so aggressively? The answer is hidden in the ratio 378 to 1. This ratio represents the relationship between paper claims and real physical silver. For every ounce of silver physically stored in vaults, there are 378 paper claims representing ownership. Imagine selling tickets to 378 guests for a lobster dinner, but the kitchen contains only one lobster. As long as nobody demands delivery, the illusion holds. But when demand surges, everyone wants the real asset. Panic begins. The exchange understands this fragility. They know supply cannot satisfy claims, so they increase entry barriers so drastically that most participants are forced out, leaving only a few who can afford to stay. The crash was simply the restaurant removing customers to avoid exposure. They would rather destroy ticket value than admit the lobster does not exist. Now consider the technical picture. Silver has fallen below the 20-day moving average and is clinging desperately to the 50-day moving average near 77 or 50. This level represents the boundary between recovery and collapse. If this support fails, severe downside volatility could follow. Meanwhile, the US dollar presents a contradictory signal. The dollar index has fallen below its 200-day moving average, indicating weakness. Normally, a weakening dollar strengthens precious metals. Yet silver declined. This contradiction reveals distortion caused by derivatives. Inflation continues rising in real life despite official reports claiming stability. National debt continues expanding toward unprecedented levels. Reality and reported data are diverging. Now observe backwardation. Physical silver remains scarce despite falling paper prices. Dealers face shortages. Premiums are rising sharply. This reveals a fractured market. The exchange succeeded in lowering the visible price but failed to restore trust. Smart capital is not abandoning silver. It is quietly accumulating physical supply. To understand the significance, look back to financial history. In 1996, Yasuo Hamanaka controlled massive copper exposure through Sumitomo Corporation. When the London Metal Exchange intervened, margin demands destroyed his position. The lesson is simple. Exchanges control leverage participants. Today, however, the opponent is not an individual trader. It is sovereign accumulation. Nations like China, India, and Russia are accumulating physical reserves. They do not rely on leverage. They cannot be margin called. While Western markets manipulate paper pricing, Eastern institutions accumulate physical supply. Now shift focus to industrial demand. Silver is essential for electrification. Every electric vehicle requires significantly more silver than traditional engines. Global electric vehicle production continues expanding rapidly. This locks millions of ounces into industrial infrastructure permanently. Additionally, artificial intelligence infrastructure requires silver for conductivity in advanced processors. Demand continues expanding structurally. Supply constraints intensify the imbalance. Geopolitical tensions amplify supply disruption. Trade barriers, tariffs, and political conflicts threaten supply chains. Nations prioritize domestic reserves. Resource nationalism is increasing globally. This restricts availability in open markets. The paper market reflects price suppression, while physical markets reflect scarcity. Now we reach the critical decision point. Investors face three possible outcomes. Scenario 1 is capitulation. Investors panic and sell. Institutions acquire discounted assets. Wealth transfers from weak hands to strong hands. Scenario 2 involves force majeure. Exchanges settle contracts in cash rather than physical delivery. Paper holders lose access to real metal. Scenario 3 is physical decoupling. Paper prices lose relevance. Physical supply determines true value. The survival protocol becomes clear. Ignore synthetic signals. Observe physical premiums. Secure ownership directly. Avoid unsecured exposure. Maintain psychological resilience. Volatility is designed to force emotional decisions. Structural shortages remain unchanged. Industrial demand continues rising. Supply remains constrained. Physical scarcity cannot be resolved through financial engineering. Paper markets can distort perception temporarily, but cannot create physical resources. The global pricing mechanism is under stress. Financial infrastructure depends on confidence. When confidence collapses, pricing authority shifts to physical holders. Those who control real assets control valuation. This moment represents a structural fracture. Emotional reactions benefit institutional participants. Rational analysis protects individual participants. The system relies on leverage and perception. Physical ownership relies on reality. In a world defined by unlimited paper creation and finite physical resources, truth ultimately emerges. Physical scarcity cannot be permanently suppressed. Market distortions eventually resolve through structural realignment. The decision now belongs to you. Fear leads to liquidation. Clarity leads to strategic positioning. The events you are witnessing are not random volatility. They are structural signals revealing systemic vulnerability. Step away from distraction. Observe reality objectively. Financial history demonstrates recurring cycles of leverage expansion and forced contraction. Physical assets endure beyond financial manipulation. Stay alert, stay rational. And most importantly, in a system built on paper promises and finite resources, protect your position wisely.